In early 2026, an unprecedented alarm rippled through the bullion and coin collecting communities. The U.S. Mint, America's own coin factory, quietly pulled its silver products off the shelves, sending customers scrambling for answers. For the first time in years, silver eagles and proof coins were nowhere to be found on the official site. A customer notice chillingly warned, "Rapidly rising silver prices may result in silver numismatic products being temporarily removed from sale while pricing is updated." Headlines blared that the U.S. Mint was pausing silver sales, and collectors refreshing the website saw only blank listings where coins should be. This dramatic freeze was not a stunt or error. It signaled a deep crisis. Silver prices had exploded and physical supply was rapidly vanishing worldwide. As one coin news source noted, in the past, the Mint has temporarily halted sales of silver products to implement upward price adjustments when silver prices rose sharply. Now, with silver at record highs, history was repeating itself, but on a much larger scale. The U.S. Mint's silence was a flashing red signal of a global silver squeeze underway. CoinNews.net. A metal wants money. Silver's historic role. To understand today's panic, we must look back at silver's place in monetary history. For centuries, silver was a bedrock of currency. Spanish pieces of 8 and Mexican silver pesos circulated globally as de facto money in the 1700s. In the 19th century, many nations were on a bimetallic standard or silver-based system. Notably, Germany's 1873 move to the gold standard triggered other nations to demonetize silver. As one commentator explains, in the early 1870s, Germany shifted from silver to gold. In 1873, the Coinage Act ended the free coinage of silver in many countries, including the U.S. By the mid-20th century, America had largely abandoned silver money. In 1965, Congress passed the Coinage Act, eliminating silver from dimes and quarters. Within years, the U.S. dollar was no longer backed by gold or silver at all. When President Nixon ended dollar-gold convertibility in 1971, the Bretton Woods system collapsed, and the classic gold-silver standards died worldwide. Silver became an industrial and collectible metal, valued less as coinage and more as commodity. Even as late as the 1970s, a dwindling number of circulating U.S. coins, the half dollar and dollar, still contained silver, but that ended by 1970. Once a pillar of currency, silver had been gradually sidelined. Ironically, some of these silver coins were later revived as collectible bullion. The modern American Silver Eagle bullion coin, 1 troy ounce of 99.9% silver, was first issued in 1986. But by then, silver's era as everyday money was over. As one analysis put it, silver had demonetized over the late 19th and 20th centuries. Today, central banks hold gold for reserves, not silver. Yet silver's monetary legacy still influences markets, even if only as poor man's gold, or hedge against fiat instability. The Hunt brothers and silver's 1980 crash. Silver's most infamous crisis was orchestrated by Wall Street billionaires, the Hunt brothers, in 1979-80. Deeply worried about inflation, Nelson Bunker Hunt and William Herbert Hunt sought to corner the silver market. Using vast oil fortunes and leverage, they attempted to control the market and drive up prices by buying up available silver bullion and futures contracts. This mania sent prices from about $11 per ounce in early 1979 to over $50 per ounce by January 1980, nearly a tenfold jump. The Hunts' buying spree created a classic short squeeze. By taking delivery on contracts instead of settling for cash, they hoarded physical silver while raising prices. Dealers and even wealthy investors scrambled to pawn their silver jewelry and heirlooms to feed the frenzy. At one point, the Hunts controlled roughly 2/3 of all privately held silver in the world. As Investopedia notes, silver prices ballooned to over $50 per ounce due to the Hunt brothers' buying spree and leverage tactics. The bubble burst on Silver Thursday, March 27, 1980, when regulators cracked down on futures trading. Margin calls exploded and prices collapsed. Silver plunged back toward $10 within months. The Hunts were ruined, and U.S. trading rules changed to prevent such corners. That episode left an imprint. It showed how volatile silver could be when supply is cornered and demand explodes. It also embedded the mythos of silver market manipulation, a theme echoed even today. Modern mint disruptions. From COVID to now. Historically, the U.S. Mint has been nimble in adjusting silver production when needed. During the COVID-19 pandemic, for example, the Mint famously paused production of 2 popular silver dollars. In March 2022, it announced that production and sales of Morgan and Peace silver dollars would be suspended for 2022 because of supply chain issues. Disruptions caused by COVID-19 impacted availability of silver blanks. Deputy Director Ventris C. Gibson bluntly explained that the pause was necessary until the supply chain for silver blanks recovers. This was a clear precedent. When blank planchets became scarce, the mint stopped issuing silver coin products. The program returned in 2023 once supplies stabilized. Now, amid this new crisis, the mint's action looks similar but far more urgent. Instead of a pandemic supply hiccup, the force is a global squeeze on silver itself, not just on blanks. In late 2025 and early 2026, the silver market saw multiple mini-crises, soaring lease rates, backing up refineries, and inventory plunges worldwide. American collectors watching the Mint site saw no 2026 Silver Eagle or Silver Proof releases on the schedule, and White House insiders surely recognized that a Mint shutdown would fuel panic. This freeze is not the Mint's first silence, but it is its loudest alarm yet. Anatomy of the 2026 freeze, timeline, and causes. Late 2025. Over the autumn, a perfect storm gathered. Silver's price climbed relentlessly, hitting new records. By mid-December 2025, futures on COMEX were trading in the mid-70s per ounce, up roughly 76% year-to-date. Physical demand surged. Retail buyers and investors scrambled for coins and bars as the Fed hinted at future rate cuts and global tensions escalated. Industrial users of silver, solar panel makers, electronics manufacturers, EV battery producers, also ramped up orders. The Silver Institute noted that industrial demand, especially green energy use, could draw an additional 200 million ounces per year by 2030. Meanwhile, supply was not keeping up. Mine output was essentially flat, about 820 million ounces annually, and could not quickly expand, as 70% of silver comes as a byproduct of other mining. October 2025, reports emerged that major U.S. refiners were turning away scrap silver. A precious metals analysis site described how dealers and refineries had halted purchases of silver, describing the market as entering uncharted territory. Lease rates, the cost for a bank to borrow physical silver, skyrocketed from under 2% per annum to over 100% in a matter of days. One dealer commented, "The silver markets shut down last night. To our knowledge, no large refiners are buying right now." This triggered a familiar phrase on social media, the silver squeeze on steroids. In practice, the normal flow of bullion was freezing. Coin supply chains were strained. Vaults reported long lead times and allocation limits. One newsletter noted that even sovereign mints instituted allocation limits or outright suspended sales of silver items to conserve dwindling metal. In October, the London Silver free float, available bar stock, had collapsed to only 155 million ounces, barely 6 weeks of world industrial demand. November 2025. A major sign came from China. The Shanghai Gold Exchange, SGE, showed that in a 7-week span ending November 21, 56% of its official silver stocks were withdrawn. That means tens of millions of ounces left Chinese vaults as consumers and industries gobbled up bars, even as global spot prices oscillated. The mismatch between falling exchange inventories and rising usage is classic of a distressed market. Meanwhile, in India, the world's second largest silver consumer, prices in rupees hit record highs. Silver jumped 178% in 2025. Indian wholesalers reported that, paradoxically, jewelry demand fell. Buyers balked at luxury prices, even as sales of silver bars and coins jumped 15%. As a money control report noted, jewelry sales fell by 15-20%, while demand for silver bars and coins continued to rise by 15-118%. December 2025. Across the West, banks and funds were accumulating massive short positions in silver futures to hedge. A CFTC report from December showed that U.S. banks were net short roughly 212 million ounces of silver on COMEX. This massive leverage stoked fears online. If physical demand remained hungry, futures markets risked dislocation. Rumors flew of central bank buying. Russia's 2025 budget had explicitly allocated rubles for precious metals, and analysts speculate the Bank of Russia quietly began stockpiling silver. Silver outperformed gold in 2025, likely fueled by these undisclosed demand factors. And tweets like, "Silver price in Tokyo hits 130 Oz. Tokyo price, Wall Street lie," circulated, hinting that retail premiums in Asia far exceeded the $70, $75 price on Western exchanges. In fact, analysis showed those headlines were exaggerating. Tokyo retail was near $80 $90 once taxes and premiums were included. But the hype underscored a real problem. Paper and physical prices were diverging. Early January 2026. By the first week of January, the Mint's customers felt something was up. Coin collectors saw no 2026 Silver Eagles or sets announced. Normally, the Mint's product schedule already lists new precious metal releases. In a press notice dated January 12, Coin News, Net reported that the Mint had yet to release any 2026 dated numismatic silver coins, noting that current 2025 designs remained on sale. Suddenly, on January 12th, Kitco and other outlets amplified analysts from Citigroup forecasting $100 silver by March 2026, as if to punctuate the Mint S warning. That day, a Mint email alert advised customers to sign up for notifications of restocks, subtly admitting that products were temporarily gone. January 13th, 2026. The official hit came. Like in 2022, the Mint quietly pulled silver eagles and other silver coins from sale. On its online catalog, where customers once clicked to buy silver bullion coins or proof sets, the links now read "sold out" or offered "remind me" alerts. Production lines had either shifted away or paused for the very reason the Mint's 2022 press release described: to ensure future supply, limited supply of silver. Observers on forums noted that coin sales were on pause, and even some scheduled release dates were postponed. Market commentary exploded. The Mint S pause was confirmation that the silver shortage had reached the very heart of the U.S. economy. Global silver supply and demand, a world on short rations. This American freeze was just one symptom of a worldwide squeeze. Silver is mined, refined, bought, and sold globally, and every major center has felt the stress. China, Shanghai. China has long been a wild card in silver. Urbanization and technology have spiked its industrial consumption, while urban and rural savers have gold and silver traditions. By late 2025, the Shanghai Gold Exchange, SGE vaults, which hold deliverable metal for both gold and silver futures, were almost empty of silver. Reports noted a dramatic 56% drawdown in 7 weeks. Even as Western traders yawned at a sideways price, Chinese actual demand was flaring. Moreover, China's state-backed bullion banks could also be quietly diverting silver into government reserves, though exact numbers are opaque. At a minimum, Chinese hobbyists were paying steep premiums. Anecdotally, Tokyo dealers lifted Japanese retail silver above $80 Oz, tax included, and Shanghai bar premiums jumped. Russia and the CIS, Russia's Kremlin openly moved to include silver in its national treasury in late 2025. With Western sanctions limiting Western metals imports, Russia has every incentive to secure its own supply. Silver also has industrial and strategic uses: electronics, solder for weapon systems, etc. Reports suggest Bank of Russia quietly built a bullion fund including silver. Meanwhile, other former Soviet states like Kazakhstan and Armenia are large silver producers. Their outputs feed global markets. But if Russia keeps more for itself, exports tighten. Rumors of Russian buying helped silver prices surge. As analysts noted, silver outperformed gold ever since Russia made this announcement. Japan. Japan is a huge silver industrial user for electronics, solar cells, and solder, and has a cultural thrift for coins and bars. In late 2025, a flurry of social media posts claimed Tokyo bullion was trading at $130 Oz, vastly above Western quotes. Investigations showed these were somewhat misleading. Much of the premium is due to local taxes. Japan's 10% consumption tax is applied on retail bullion, and small bar premiums. For example, Tanaka Precious Metals listed a silver price at 418 JPY gram on Deck 26, 2025, equivalent to roughly 83 O's after currency conversion, still a premium, but not 130. By mid-Jan 2026, Tanaka S price was 521.84 JPY G, $90-$100 Oz, reflecting the rally. In short, Japan's market was very tight, with both yen weakness and strong demand pushing retail prices above Western spot by perhaps 10 to 20%. Local dealers report limited allotments. India. As noted, India's vast silver appetite is split between jewelry and investment. The rupee price of silver soared nearly 178% in 2025, but cultural habits flexed. Gold and silver jewelry sales plunged in the face of steep prices, whereas demand for bullion coins and bars jumped 15-18%. In a normal year, December is peak festival and wedding season for India's precious metals consumption. Instead, Indians are buying bars on dips to protect wealth, much like the rest of the world. The India Bullion and Jewelers Association confirmed this paradox. Silver jewelry sales fell by 15-20%, even as demand for silver bars and coins continued to rise by 15-18%. This shift amplifies investment demand globally. India's government recently allowed duty-free import of minted silver coins to curb smuggling, a sign of how serious the situation is. Switzerland. Switzerland is home to the world's largest bullion refiners, Valcambi, Pamp, Heraeus, and major vaults for London bullion. Reports show Swiss refiners were overwhelmed in late 2025. Delivery times stretched to 10 to 14 weeks. Premiums jumped. One newsletter noted wholesale premiums at $6 to $10 Oz and retail at $12 to $50 above spot. Also, attempts to ship silver into and out of Switzerland faced new frictions. U.S. import tariffs on certain goods, along with higher insurance and trucking rates, made shuttling silver between London and New York more costly. Essentially, even global vault redistribution slowed. LBMA inventories, London bullion, kept collapsing, and there was talk that Zurich might have to ration exports. Canada, the Royal Canadian Mint, RCM, is one of the biggest silver coin producers, famed for the silver maple leaf. Canada's mines are also major silver suppliers. Nickel and gold mines are big sources. In 2025, some Canadian refineries reported lease rates jumping off normal levels, 12%, up toward 100% by October. The RCM's own production information shows total 2025 maple leaf output still high. But behind the scenes, they increased premiums and adjusted production to manage costs. One analysis noted several mints instituted allocation limits or outright suspended sales of certain items to ensure future supply. Other players, countries like Mexico, Peru, Australia, and China, are also top silver miners, but Mexican production, the largest global mine supply, was already declining. The combined output from all mines worldwide was roughly constant at $820 million Oz in 2025, versus consumption of over 1.2 billion Oz. 5 consecutive annual deficits have drawn nearly 900 million ounces out of reported inventories since 2021. In short, no corner of the world was immune. The silver tap was turned down everywhere. Together, these trends created a panic environment. Dealers reported for the first time ever they were simply unable to get certain silver products, not for lack of buyers, but lack of metal. One blog summarized it. Retail orders have shot up 5.66 normal levels, while physical supply is frozen, a perfect storm of soaring demand and frozen supply. It may be no coincidence that every major silver hub, New York, London, Zurich, Mumbai, Shanghai, was effectively at a breaking point simultaneously. The financial fallout, systemic risks, and currency angst. A scrambling mint is a symptom of deeper undercurrents in the global economy. Silver, like gold, is often a bellwether for bigger waves in finance. As the silver freeze unfolded, voices warned of systemic risks and currency turbulence, inflation, and debt. Central banks worldwide have pumped massive amounts of money into economies post-2020. US M2 money supply hit record highs, and government debt soared. Investors like Ray Dalio have been warning that treasuries are suddenly not so safe. Dalio pointed out that with US debt over $37 trillion, treasuries are no longer the most secure investment and favored gold as a hedge. He even put a chunk of Bridgewater funds into gold and presumably silver, and advised mainstream investors to hold 10 to 15% of their portfolios in physical metal. In a sense, silver is currency insurance. As Doman, cited below, remarks, there's a global rush out of depreciating currencies into tangible assets, hard assets like precious metals. Systemic fragility. A dozen years after the 2008 financial crisis, credit markets still brim with leverage. Doman warns that today's margin debt, leveraged ETF positions, and AI stock bubbles create a risk worse than 1929. In his view, the only real money is gold, and by extension, silver. If this stress triggers a bank run or swaps crunch, a panic flight to metals could intensify abruptly. The concept that paper money relies on trust means that if confidence falters, real metals become refuge. Some analysts note that this flight may already be happening quietly. Global central banks, especially in developing nations, have been accumulating gold and apparently silver to hedge against fiat devaluation. Inflation. High consumer prices have not gone away. The US CPI is still above 2%, and many emerging markets suffer double-digit inflation. Silver, with long industrial demand, often lags gold as an inflation hedge, but it is now catching up. As one interviewee put it, soaring costs and uncertainty are encouraging consumers to defer purchases, which in turn pushes them into safe assets like bars and ETFs. Indeed, Money Control reported a dramatic decline in Indian jewelry purchases simply because affordability is out of reach. The result is that ordinary savers globally are anchoring wealth in metal, fearing currency loss. Silver, being more affordable than gold, becomes an obvious outlet for this demand. Currency moves. Alongside inflation, currency volatility feeds the story. The yen, for example, has weakened significantly, lifting Japan's import prices for silver, heightening local premiums. Emerging currencies have also tumbled against the dollar, driving citizens in places like India and Turkey into physical silver as a store of value. On the flip side, a crisis of confidence in any major currency, USD, EUR, CNY, could send foreigners further into gold and silver. Banking strains. Rumors swirled that some banks might be vulnerable due to massive short positions in silver. The CCN analysis showed U.S. banks net short about 42,000 COMEX contracts, 212 million ounces. That's an enormous liability if holders call their shorts. News media and even a comedian S. Skit joked that JP Morgan's big silver short could topple it. However, experts caution that banks hold large silver derivatives positions, creating liquidity risk, not proven insolvency risk. In other words, unsettled futures are a potential headache, but not necessarily catastrophic on their own. Nevertheless, any sign of bank distress could send silver and gold spiraling as panicked investors seek tangible assets. In sum, the freeze at the mint is a symptom of macroeconomic anxiety. High government debts, aggressive money printing, volatile markets, and geopolitical tensions are all colliding, with silver's plunge into chaos reflecting those stresses. The palladium-like shroud of uncertainty around central banks and currencies is turning up in these nickels and ounces of metal. Silver under siege. Manipulation. Theories and narratives. As the physical market tightened, the ever-present specter of silver manipulation reemerged in financial chatter. Longtime silver enthusiasts have a litany of grievances, paper versus physical. Many argue that Western futures markets bear little relation to actual metal. A flurry of memes contrasted a $71 silver on Wall Street with mysterious 130 quotes in Asia. Technically true, COMEX and LBMA silver traded in the low 70s by early Jan 2026, while retail prices in Japan and elsewhere, including taxes and premiums, approached $80, $90 and occasionally spiked on small quantities. This disparity is a natural outcome of delivery constraints and regional demand, but it fueled talk of a bifurcated market. Analysts noted that physical silver is trading at dramatically higher prices in parts of Asia and the Middle East, painting it as a confession of market dysfunction. Banks and shorts. For years, critics have accused big banks of manipulating silver via futures. JP Morgan paid nearly $900 million in 2020 over past silver and gold allegations. Now, posts on social media and forums declared, "I told you JP Morgan is short," whenever price wavered. The CCN breakdown actually shows U.S. banks are heavily short in futures, which is partly because one of the few regulators permitting shorts is the privileged status banks enjoy. But there is no current evidence of new illegal activity. As the CCN analysis put it, calls of a new JP Morgan silver manipulation are allegations, with no current regulatory action confirming them. In effect, banks taking the other side of frantic buying is not unheard of. That said, if banks were secretly failing to honor physical deliveries, a reckless game of chicken, it could turn into a real crisis. So far, however, regulators have not interrupted any trading, even as some counties, like Germany and the US, are reportedly investigating pricing dynamic, central banks, and BRICS. Another theory is that governments themselves are at play. The news that Russia and possibly other BRICS nations, China, India, etc., are stockpiling precious metals spiked imaginations. An Australian journalist noted that Russia's addition of silver to its state reserves coincided with silver's new highs. The Jerusalem Post asked if silver could become a new reserve currency like gold. If friendly central banks or Chinese state-owned firms were quietly hoovering up thousands of tons of silver, that would explain the disappearance of metal. On that note, China's huge declines in vault holdings hint at something more than small investors. If enough governments had a secret buying program, they could stress the market without anyone on the exchange knowing. But by the same token, such actions are likely legal national reserve moves, unlike a private cornering bid. Shadow banking. There's talk of unregulated flows. Some suggest that dealers in Hong Kong and the Middle East are paying higher prices to reroute metal, leaving Western exchanges thin. Others point to paper silver ETFs like SLV, whose unbacked shares couldn't keep up. On Dexinger 2, 2025, SLV actually had 0 shares available to borrow, an unprecedented sign of short covering trouble. People have even created crypto tokens, supposedly backed by silver, to capitalize on the frenzy. These stories add to a popular narrative that what's happening in physical markets will eventually force the paper market to realign, possibly at much higher prices once the crunch is resolved. All these theories reflect anxiety, the idea that big money is toying with metal, or that some stealth force, like the Fed itself or foreign power, is setting the price. Whether any particular conspiracy is true or not, the effect is that faith in the smooth function of markets has eroded. In any case, analysts caution that many so-called manipulation claims might just be human pattern seeking. The CCN report cleverly noted, this is not a conspiracy theory. It's how futures markets work by design. The reality is murky. Some of the supply disruption is purely real, inventory-driven, some due to finance, tight credit, and some possibly strategic, national reserves. Investors take gold bugs and money men, With silver storm clouds overhead, the world's famous market sages have chimed in. Their words help frame the turmoil. Ray Dalio, Bridgewater. Dalio has been blunt about the fragility of fiat. In late 2025, he warned that the U.S. debt situation creates hidden risks for treasuries, the traditional safe asset. He put it plainly, "You should know that credit ratings understate credit risks. Countries will print money to pay their debts, thus causing holders of the bonds to suffer losses from the decreased value of the money they were getting." In that environment, Dalio has been buying gold and likely silver as insurance. At the 2025 Abu Dhabi Forum, he advised having around 10-15% in gold as a portfolio hedge. In his words, faced with clogged arteries of debt, gold helps investors shield themselves from markets running on debt, manipulation, and central bank intervention. His message extends to silver by implication. Any flight from fiat should lift both precious metals. Peter Schiff, economist podcaster. Schiff, long a gold enthusiast, has for years preached that paper currencies are doomed and precious metals are real wealth. While we lack a direct quote here, he has predicted silver rally to 100 plus before 2026. Indeed, Citigroup's $100 forecast echoes what Schiff's followers expect. Schiff often refers to silver as the poor man's gold and has warned of dollar collapse. In the current crisis, he has repeatedly told audiences that this is why one should already own silver coins, cautioning to not wait on buying before even higher prices hit. His style is hyperbolic, but he highlights that U.S. fiscal profligacy and Fed intervention underpin the move. Jim Rogers, commodities investor. Rogers famously walked away from Wall Street decades ago to bet on commodities and farmland. He has warned similarly about fiat currencies and loves the inflation trade. In interviews around 2025, Rogers echoed that the price of money is no longer stable. And he said decades long that the U.S. dollar would weaken. Rogers has advocated owning natural resources, including silver. When asked about it, he said he holds gold and silver and won't sell, no matter what. If pressed for a forecast, he suggested silver could easily move by orders of magnitude in the coming decade if debt crises emerge. Although like Schiff, we don't have a neat soundbite to cite here. Warren Buffett, Berkshire Hathaway. Buffett is famously skeptical of precious metals. He quipped that gold, and by extension silver, is neither of much use nor much fun. Gold is a way of going along on fear, he once said, indicating that gold rises when people are afraid, not because it does anything productive. For most of his career, he avoided gold. Yet even Buffett surprised Wall Street in 2020 by having Berkshire buy $565 million of Barrick Gold stock, though that position was trimmed within months. For all his caution, Buffett acknowledges that in times of panic, gold and silver can serve as a hedge. The lesson: even the odds-on stock picker saw value in precious metals at the bottom of the COVID crisis. Collectively, these heavyweights agree on one thing. In an era of stimulus, debt, and instability, holding something real is prudent. Some split hairs, gold versus silver, cash versus crypto, but the consensus is that paper currencies are on thin ice. As Schiff says, and Buffett's interview implies, if the monetary system wobbles, fear of overpaying keeps people buying hard assets. Glimpsing the future. Where does silver go next? As 2026 unfolds, every silver holder, from small savers to central bankers, is pondering what comes after the freeze. Will this be a quick hiccup or a wholesale reset for precious metals? Analysts and strategists offer various forecasts. Short-term surge, then volatility. With supply so constrained, many expect silver's price to keep climbing at least in the near term. Earlier in 2025, Kitco News cited Citigroup predicting silver at $100 by March 2026. Other large banks have wildly broader targets. Bank of America. Analysts said silver could top out between $135 and $309 by late 2026. UBS and Goldman Sachs in 2025 gave gold $5,000. By analogy, some put silver well above $100. On the other hand, these reports often come with a caveat. They warn of a later correction as fundamentals, like economic growth or interest rates, shift. In one note, Citi cautioned that once metals peak, gold, and by extension silver, could be vulnerable to a pullback. So, in a forecast sense, explosive gains in 2026, followed by possible consolidation or volatility in 2027. Industrial demand expansion. The long-term narrative is very bullish. Silver's uses are expanding, not contracting. The rollout of 5G, solar, electric vehicles, water purification, and even new tech like battery electrodes will raise industrial demand steadily. The Silver Institute points out that over 50% of silver demand is industrial, and that this share is likely to grow. Many EVs use silver wire or plating, and each solar panel contains ounces of silver, necessary for photovoltaics. Some forecasts say that global silver demand could exceed 2 billion ounces annually in the next decade. If supply remains constrained, new mines take years to develop, that implies chronic upward pressure on price. Monetary revival? Some futurists speculate that if fiat currencies continue to falter, we might see a partial monetization of silver again. Russia ES purchase may be a hint. If more central banks decide, oh, gold, S-friend, is worth stocking, that could create a new monetary premium. India's government has contemplated minting silver coins for household saving. Cryptocurrencies and digital tokens might even get tied to silver in speculative products. It's not impossible that in 10 to 20 years, silver could be reintroduced in some form of coinage or reserves, though on a much smaller scale than the old silver certificates. Environmental and social factors. One wildcard is how environmental pushbacks might affect silver. Mining has a heavy carbon footprint. If governments clamp down on new mines for emissions or land use reasons, that could further restrict supply. Conversely, investment in recycling could increase if prices justify it. Urban mining, recovering silver from used electronics and solar panels, might become attractive at high prices, which could eventually add some supply. Competition with crypto. Finally, some ask whether Bitcoin or other cryptocurrencies will temper silver's rise. In the very short run, crypto has shown volatility. Bitcoin is off from its 2025 peaks. Some theorize that as silver rises, capital flows out of paper, banks, bonds, fiat, into something. That could mean precious metals and crypto. Analysts at CCN suggested that capital might rotate to Bitcoin as a digital form of escape. But others argue that silver's physical scarcity and industrial base make it a safer bet than the no-yield crypto. In any case, 2026 might see silver and Bitcoin moving in tandem as alternative assets. In a nutshell, the bull case for silver is now stronger than ever. The perfect storm of supply deficits, rising global demand, and faltering confidence in currencies means that, if anything, silver's baseline value is shifting upward. Of course, markets are chaotic and prices could fall if, say, a big financial crisis temporarily cracks commodity prices, or if an unexpected flood of silver, e.g., a new major mine, occurred. But at present, most experts agree we are on the higher side of the re-rating curve. Conclusion: between panic and opportunity. As the U.S. Mint sat silent in January 2026, it was a stark symbol, a once mundane institution now caught in a drama of financial uncertainty. The halt in silver sales is more than a coin collector's inconvenience. It's a manifestation of global economic tremors. Like the Hunt Brothers Corner in 1980 or the Wilson-era end of coined silver, this event will be studied in numismatic and financial chronicles alike. For viewers at home, this means one thing: pay attention. The price of silver is no longer a sleepy story. Every headline, tweet, and tweetling about silver might matter, because we may be glimpsing the edges of a new monetary age. If history is any guide, few anticipated Silver Thursday in March 1980 until the week before it happened. Likewise, few foresaw in late 2025 that ordinary Americans would be locked out of bullion coin sales. Will the freeze last weeks or months? Will physical premiums become permanent features? Will government step in, for example, by strategic releases or by legal changes? No one knows for sure. But behind the scenes, people like Ray Dalio and Peter Schiff are nodding. This is the kind of moment they expected when they said we re-exiting the era of cheap money. As one analyst ominously put it, when a crisis comes, it comes suddenly. Silver's sudden roar is a crisis of sorts, but also an opportunity. For investors holding physical metal, this could be vindication. For speculators, it's a chance at huge gains if they buy fast. And for regular people, it's a reminder that financial stability is fragile. Wealth stored in paper can vanish in an instant, while metal remains real. In the end, the Mint's halt is a wake-up call. It tells us that something fundamental is shifting in global finance. Whether silver soars to triple digits or merely doubles, the trust in purely paper money has been shaken. For the silent U.S. Mint, it's been a loud warning. The old rules have changed. And as the silver saga continues to unfold, one thing is certain: the world will never look at those shiny coins the same way again. Sources. Historical and market data are drawn from specialty outlets and research, e.g., Investopedia, Coin News, bullion market analyses, including reports of lease rates and deficits, the U.S. Mint's announcements and statements by financial analysts and investors.